In this video, we're going to talk about some of the characteristics that distinguish different types of mutual funds from one another. So one really basic distinction is whether a mutual fund is actively or passively managed. And what we mean when we say active or passive is basically whether the manager is trading a lot. So if the manager is saying, you know what, I've got a really good feeling about Microsoft, I'm going to buy this, and I've been given the green light to do that by the investors in this mutual fund. This is consistent with our mutual fund's goals. We invest in the technology sector, and so that manager is doing research and acting on that research and trading when he or she feels that there's money to be made for the fund. But with a passive fund, it's a lot different. With a passive fund, it might be something like an index fund, right? So there's not any trading going on. It's just you buy an index. For example, let's say the S&P 500. You just tell the manager to say, look, I just want, in this fund, we just want you to own all the stocks that are in the S&P 500. So then it's really simple for the manager of that fund. They're not having to make decisions about which trades to execute. They're just saying, look, it's just my job to buy an equally weighted portfolio of stocks of firms that are in the S&P 500 or in some other index. And so then it's passive in the sense that the manager really doesn't have to do much, right? They're just kind of an automaton. So this is going to affect something called the expense ratio. So the expense ratio is going to be higher for these actively managed mutual funds. And the expense ratio is just a percentage of the assets, the net assets that are in the mutual fund, right? And so this expense ratio is actually a function of multiple things. But one thing is what we're paying the manager, right? So we're paying the manager a fee to manage the fund. And if we are asking the manager to actively trade and to use his or her knowledge to try and execute trades that will increase the value of the fund, now, hey, that requires some thinking and a lot of research. And so the expense ratio is going to be higher. So there's going to be a higher expense ratio when we have an active fund rather than a passive fund. Another thing that can distinguish mutual funds is whether there's a load or not. And if you're saying, well, what is a load? This is, let me go with a different color here so we know. So a load is basically an expense that's going to be charged up front. You can have a load or no load fund. Some funds don't have this at all. But assuming that a firm, that a fund does have a load, you can have a front end or a back end load. And so a front end load would basically be the following. You say, look, the manager of the fund says, look, if you manage or if you invest in this fund right up front, I'm going to take, let's say, 5%. I'm going to take 5% of your investment when you invest. Now that's different from this expense ratio that we're talking about paying the manager a percentage of the assets that he or she is managing. This is different. Right? This front end is a one-time fee when you enter the fund. So let's say you invested with $100 and there was a 5% front end load. That means that basically you just have $95 in the fund because the manager took, or the fund took $5 off the bat out of your investment as the front end load. So that's just a one-time charge, and then you'd have to pay the manager the expense ratio, or you'd have to pay them a percentage of assets to manage the fund as well. So a back end load would be charging you when you want to get out of the fund. So you say, you know what, I want my shares back, I want my money back. I'm decided to sell my shares, so you can get a charged a percentage at the back end. Now, a no-load fund, well, it's pretty simple. You're not going to have a front end or back end. There's not going to be any kind of charge like this. That doesn't mean there's no charge at all. You still have an expense ratio where you get charged a percent of the assets and so forth, but you're just not having this load. You're not having a one-time charge when you invest in the fund or try to get out of the fund. And historically, no-load funds have tended to outperform load funds, if for no other reason than basically, look, here you've got $95 that is invested or working for you up front, whereas if you did a no-load fund, you have $100. So the $95 is like having to play catch-up right off the bat, right? So even if there's a higher percentage return for this fund that has a load, even if they make 12% return instead of 11% or of like a no load, you still have to recover that $5, that 5% you lost up front. And so that's a real reason to not consider any kind of fund that charges a load, or if you do want to go with one that has a load, to make sure it's really low, like 1, 2, 3%. And we can also categorize mutual funds by kind of the purpose or the goal of the fund. And so, for example, you have a growth fund. Let me change the color again so we don't get too confused. So you have a growth fund where you're saying, I really want this fund to focus on capital appreciation. When we're talking about capital appreciation, we're buying maybe riskier firms that we think the stock price is going to go up. They're not necessarily paying a lot of dividends. There's not necessarily a lot of bonds or anything, fixed income securities in this fund. We're just saying we want to buy a pool of securities that we think is going to go up in value. And you might say, well, don't we want all assets to go up in value? Well, yes, but you can also focus on an income fund where you say, look, I don't want the risk of growth as much. I want more income right now. I want like fixed income securities. So you might have bonds in there, or firms where you own a stock that pays a dividend. So then there's some income coming. You're not concerned so much that the price of the share price of these firms is doubling every couple of years or something like that. You're more saying, look, I just want a steady income. But you can also have where you say, you know what, I just want an index. And we've mentioned this already. You could just say, I want an index fund. And what happens here is you just get an entire index, like the S&P 500, something like that. So you're just getting an entire index where the manager is just being told, look, buy an equally weighted share of all the firms that are in the S&P 500. So if the S&P 500 goes up 10%, your investment goes up 10%. It's really simple. And then there's not really any decision making on the part of the manager, and you really, it's the ultimate way to diversify. You can also say, well, I want to be a little risky, and I say, you know what, I really like the tech sector, or some specific sector, maybe the grocery market sector, and you say, I want this sector, I want to be invested in just tech stocks. So I really think good things are going to happen with tech stocks, and so you can go with a sector fund that just invests in funds from that sector. And you could have a balanced, which is basically a mix of growth and income. You can have a balanced fund. There's any number of funds. You can even have life cycle funds, where a life cycle fund is basically saying, look, we're going to try and invest in such a way that basically you would have earlier in your life, you would have more capital appreciation, more stocks, and then as you get later in life, you would have more fixed income securities and income from bonds and dividends and so forth. So there's a large number of these different types of purposes and so forth for mutual funds. Make sure you read the prospectus before you invest in any mutual fund to see what you're getting into. But another distinction is versus open or closed. So when we say that a fund is open or closed, what we mean is this. So with closed, there's a fixed number of shares. When the fund opens up for business, there's a fixed number of shares, or I should say when the fund is started. When somebody starts this fund, they say, look, there's 1,000 shares, let's say, of this fund. So let's say there's 1,000 shares. So to buy a part of this fund, to get in, you have to buy shares from somebody else. Right? The fund isn't going to issue any more shares. There's just 1,000. It's fixed. So if you want to buy one share, somebody in the fund has to be willing to sell you the share. And so for that reason, these shares will be traded on an exchange. So they're traded on an exchange. And so an open fund is saying, instead, well, at any time you can just buy a part of this fund. And you buy the reason you don't buy from the exchange, you get the shares from the fund itself. So if the fund had 1,000 shares, say there was 1,000 shares, and you wanted to buy 100 shares, so then they sell you the 100 shares, and then now there are 1,100 shares in the fund. So the fund can be increasing in size, right? So it has more shares and more capital. The closed fund is just going to be a fixed number of shares, and so you have to buy the shares not from the fund itself, but on an exchange from a person who owns shares in the fund and wants to sell. So those are two main types. There's also been an increase in the last 20, 25 years in something called exchange-traded funds. And exchange-traded funds, ETF for short, are basically, they're also traded on an exchange, just like the closed funds. However, they tend to trade a lot closer to something called their net asset value, which we'll talk about in one of our upcoming videos. They're basically the value of the assets in the portfolio. And suffice it to say that exchange-traded funds, these ETFs, normally track some kind of index. So they'll track something like the S&P 500. That doesn't mean that they're necessarily less risky than a closed fund or so forth, because in some cases they might be set up in such a way, they might be some ETF that's called like the S&P 500 2X or 3X, and it's set up in such a way that if the S&P 500 were to go up, it were to triple in value, then your fund would go up 3 times whatever the S&P 500 went up. So if the S&P 500 went up 10%, you would go up 30% for the day, and vice versa. If the S&P were to go down 10%, then you would go down 30%. And so they can be risky. Not all of them are set up like that. But there's also, and I should mention, there's also something called a unit investment trust, UIT, which is basically a fund that's going to have a finite life. And we'll have a video talking about unit investment trusts in more detail. But by finite life, I say that, for example, when the fund is started, you say, you know what, this fund is just going to exist for 20 years, and then that's it. So at the end of 20 years, no more fund. Everybody gets their assets back, and that's the end of it. So, and we're going to talk in the videos to come. We're going to have a video kind of looking at the difference between open and closed funds in more depth. We'll talk about exchange-traded funds and so forth in the video.